Honasa consumer is the one to look out for because that has come out with a weaker than estimated quarter. When you take a look at the second quarter, you do have the profit after tax as well as EBITDA turning to loss. Higher than expected inventory correction was also something that was seen this quarter. In fact, we do have Snehi standing by with the earnings fine print. Snehi?
Well, yes, so if we take a look at the Q2 numbers coming in from Honasa consumers, it's been a weak set coming this time. They have missed all the street expectations. Revenue was coming at 418 crores compared to 460 crores, which is down 9.3% on a year-on-year basis. EBITDA, there's a loss this time coming in at 29 crores versus an EBITDA of 46 crores this time last year. And they've also incurred a net loss on an overall basis of 18.5 crores compared to a profit of 29.5 crores this time last year. Another Q2 highlight to note is that during the Q2, they received the NCLT nod for the merger of Just for Kids Service Private Limited and Fusion Cosmeceuticals with the company. So that's a highlight to keep in mind for them in Q2. However, now when we talk about the con call highlights, what both Varun and Ghazal Alag had to say is that they've experienced a higher than expected inventory correction this time, which has weighed on their numbers. The increase in inventory of traded goods has led to an exceptional loss of 37.5 crores on the bottom line, and Honasa has introduced a revamped distribution approach that they call Project Neve in Q4 of FY24, which they've executed in this quarter. Now, this model focuses on transitioning to a direct distribution model in the top 50 cities and reducing its dependency on super stockists. Now, however, despite this, the inventory correction was due to a pocket of sub-distributors that the company had not taken into account. So that is something that has weighed into the earnings this time. It's led to an inventory impact of 63 crores and roughly a 70% loss in the gross margin. However, earlier the company had expected the impact to be between 40 and 50 crores, but it's come in at 63 crores this time. Inventory related provisions have further impacted the EBITDA margin by 10.7%, and with much of this transition already completed, Honasa expects momentum to gradually recover over the next few quarters. Varun Alag has also said that the company is going to rethink their strategy in 4 to 5 key areas. Now, while these was the numbers, quickly giving you a rundown on what brokerages are making of these numbers. Goldman Sachs has downgraded the stock to neutral from a buy rating, also cut the target price to 375 from 570, so it's a very steep cut coming in. They say that reset in Mamaearth pushes out the earnings trajectory. Q2 revenue has declined, driven by the large pipeline inventory correction. There is a deterioration in the growth trajectory driven by the core Mamaearth brand as well. Long-term potential to ride the consumer shift towards science-based skincare remains intact, however, so that's something that they're liking, but repositioning will take time is what they're saying. So overall, weak set of numbers coming in, a miss across all fronts.
Okay, miss across on all fronts, and of course the shift in strategy which has impacted their inventory as well as impacted their margins heavily. Thanks very much, Snehi, for even getting the view on the what Goldman Sachs has to say on the stock. But then let's talk about